Market equilibrium, finding the sweet spot. In our first two lessons of this section, we examined the two most powerful forces in any market economy, demand and supply. We looked at the world through John's eyes as a buyer, weighing his personal value and income against market prices. Then, we flipped the script to look through his eyes as a producer, where costs and technology dictate his willingness to sell. However, in the real world, these two forces do not exist in isolation. They are constantly interacting, pushing and pulling against one another in a tireless dance to find a state of balance. In this lesson, we're going to bring these two curves together on a single graph to find what economists call the sweet spot, the market equilibrium. This is the point where the plans of buyers and the plans of sellers align perfectly. According to N. Gregory Mankiw, the term equilibrium describes a situation in which the market price has reached the level where the quantity supplied equals the quantity demanded. To understand finance and economics at Ivy League level, you must master how prices find this magical point and why they stay there until something fundamental changes. Let's return to John and his custom mechanical keyboard business. John has his upward sloping supply curve, which shows how many high-performance keyboards he is willing to build at various prices. On the other side of the market, there are hundreds of developers and gamers, the consumers, who have their own downward sloping demand curve, showing how many keyboards they are willing to buy at those same prices. To find the equilibrium, we plot both of these curves on the same graph, with price on the vertical axis and quantity on the horizontal axis. There's only one point where these two curves meet. This point of intersection is the market equilibrium. The price at this intersection is called the equilibrium price, and the quantity is called the equilibrium quantity. At the equilibrium price, the amount of the good that buyers are willing and able to buy exactly balances the amount that sellers are willing and able to sell. This is often referred to by economists as the market clearing price, because at this price, everyone in the market has been satisfied. Buyers have bought all they wanted to buy at that price, and sellers have sold all they wanted to sell. There are no frustrated shoppers leaving empty-handed, and there are no dusty boxes of unsold keyboards sitting in John's workshop. But why does the market move toward this point? Why doesn't the price just stay at some random level forever? This is where the logic of market forces becomes truly fascinating. Imagine for a moment that the current market price for John's keyboards is significantly higher than the equilibrium price. Let's say the equilibrium price is $200, but John and other sellers are trying to charge $300. At this higher price, the law of demand tells us that consumers will want to buy fewer keyboards. Simultaneously, the law of supply tells us that John and other producers will want to supply a lot more because the profit potential is so high. This creates a situation known as a surplus or excess supply. There's a visible gap between what is supplied and what is demanded. John finds that his inventory is piling up, and he isn't making the sales he expected. To clear out this excess stock, John and his competitors have a rational incentive to lower their prices. As they cut prices, the quantity demanded increases because the keyboards are now cheaper, and the quantity supplied decreases because it's slightly less profitable to build them. This downward movement continues until the price reaches the equilibrium of $200, where the surplus finally disappears. Now, let's look at the opposite scenario. Suppose the market price is lower than the equilibrium price. Perhaps it's only $100. At this low price, every developer wants one of John's keyboards, so the quantity demanded is massive. However, at $100, John might barely be covering his costs for parts and labor, so he is only willing to supply a very small quantity. This creates a shortage or excess demand. There are too many buyers chasing too few goods. Buyers start to complain, long wait lists form, and some customers might even offer to pay a bit more just to get their hands on a keyboard. Seeing this intense demand, John realizes he can raise his prices without losing sales. As the price rises, the quantity demanded begins to fall as some buyers are priced out, and the quantity supplied increases as John is motivated to work overtime. This upward pressure on price continues until the market once again hits the equilibrium point. This natural, automatic adjustment is what economists call the law of supply and demand. the claim that the price of any good adjusts to bring the quantity supplied and the quantity demanded for that good into balance. This self-correcting mechanism is the foundation of market efficiency. In a free and competitive market, there is no central planner or government official telling John what price to charge. Instead, the invisible hand of the market guides the price to the level where total surplus is maximized. At the equilibrium point, the value to the buyers, as reflected in their willingness to pay, is exactly equal to the cost to the sellers, as reflected in their supply curve. For John, understanding equilibrium is essential for his corporate finance strategy. If he tries to fight the market by pricing too high, he will lose money on unsold inventory and storage costs. If he prices too low, he is leaving money on the table and failing to capture the full value of his labor. By identifying the equilibrium price, John can optimize his production schedule and his cash flow. He knows exactly how many units to produce to meet the market's appetite without wasting valuable resources. This concept extends far beyond keyboards. Whether you're looking at the price of a stock on the New York Stock Exchange, the interest rate on a corporate bond, or the value of a cryptocurrency, you're looking at a market's attempt to find equilibrium. It is a dynamic, living process. In our next lesson, we will look at what happens when outside forces like government intervention prevent the price from reaching this sweet spot, creating permanent surpluses or shortages. But for now, remember that the intersection of supply and demand is where the most value is created for society. It is the point where the market clears, and it is the foundation of every financial decision John will make as he grows his business. Mastery of the equilibrium point is what separates a mere participant in the economy from a true strategist who understands the underlying heartbeat of the global marketplace.